Thanks for clicking. All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of September, with the majority of the big banks expecting inflation to remain steady at 4%. We got our answer at 8:30 this morning when Canada's CPI came in at 3.8%, much lower than expected.
Yeah, no, I think we're good.
And while the reduction in the CPI is definitely good news, the report comes amid the newly released Canadian Survey of Consumer Expectations, which showed that Canadians think that inflation is much, much higher than that which is being reported by Stats Canada.
Yeah, no Sherlock!
In the Survey of Consumer Expectations comes along the Business Outlook Survey, which found that not only are businesses planning on further price increases, but also that their outlook on the Canadian economy is souring, which, as we'll see, is not a good combination. So what I want to do today is go over Canada's inflation data for the month of September, take a look at the Canadian Survey of Consumer Expectations and the Business Outlook Survey, look at the implications of those surveys for the Canadian economy, and then discuss what to look for next. Speaking of next, the Bank of Canada is set to make its next policy rate announcement next Wednesday, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this inflation data. As mentioned, Canada's CPI came in much lower than expected at 3.8%, down from the previous month's 4%. StatsCan said that the year-over-year deceleration was broad-based, stemming from lower prices for travel, durable goods, and food. Food price growth slowed to 5.8%, still far too high, but much better than the double digits that we've seen in the past. Measures of core inflation, which excludes more volatile items like food and gas, and the measures which the Bank of Canada looks to when deciding whether or not to raise rates, also fell, with CPI median slowing from 4.1 to 3.8, and CPI trim slowing from 3.9 to 3.7. So, headline inflation down to 3.8%, core inflation showing signs of slowing, all good news coming from Stats Canada this morning.
Get their names to sell them.
However, it is worth briefly noting that the bond market barely blinked on the news of Canada's slowing price growth, with yields still elevated for the day. In fact, yields are still much higher than they were in the aftermath of last month's hotter-than-expected inflation release, indicating that other factors, such as U.S. Treasuries and the U.S. cost of borrowing, has much more of an effect on our economy than our own inflation rate. And it's not just the bond market that might be shrugging off the news coming from Stats Canada. As the recent Canadian Survey of Consumer Expectations showed, Canadians think that inflation is much, much higher than that which is being reported by Stats Canada, with most respondents thinking that the CPI is actually about 3.5% higher. Further, the survey also found that inflationary expectations of inflation for the future, have leveled off. After initially dropping fast in the fourth quarter of last year, Canadians are no longer expecting inflation to get much better in a year's time. Taken together, that Canadians think inflation is much higher than that which is being reported, and that they don't expect it to get much better in a year's time, this is exactly not what the Bank of Canada wants to see, as it has said over and over and over again that it looks at inflation expectations when making interest rate policy. And the reason, as we've discussed before, is that inflation expectations can become a self-reinforcing loop. Canadians spend now to avoid paying higher prices later, leading to higher inflation.
If people believe inflation will remain high for the long term, they will pay higher prices now to avoid even higher prices later. And that only makes it easier for businesses to keep raising prices.
So, if businesses can increase prices now knowing that consumers will pay it, they will.
You are speaking to me.
And, judging from the Business Outlook survey released this week as well, that's the plan, with businesses reporting that their pricing behavior still remains abnormal, and that they plan to pass on further price increases over the next 12 months. In fact, citing, in part, wage increases, firms are actually planning on passing on marginally more price increases over the next year than they did previously. And another reason for the price increases, according to the survey, is that businesses also expect inflation to remain higher for longer, with businesses still expecting the CPI to be above target in 1 and 2 years' time. So, consumers and businesses, despite all of these rate hikes, despite the slowing of inflation, still expect inflation to be well above target in 1 and 2 years' time.
I'm a little baffled, but yeah.
However, of particular concern in this survey is not only that businesses plan on raising prices, but also that they report a weak economic outlook, with indicators of future sales dropping to the lowest point that they've been since 2008. In the face of a subdued economic outlook, we'd expect businesses to maybe not lower prices, but at least not plan on raising them. But we're not seeing that in this environment. Even with businesses expecting the economy to slow, they still plan on raising prices. And that's stagflation. Stagflation, as we've talked about before so many times on this channel, is low economic growth combined with high inflation, and represents a real problem for the central banks. The central bank can't lower rates, as doing so would lead to more inflation, and they can't, or are reluctant to, raise rates to curb inflation, as that will put more downward pressure on the economy. And if the economy does weaken amid higher prices, I think it's worth noting for the usual suspects, the central banks, absent a major black swan event, have always chosen inflation. They've always chosen higher rates to curb inflation. And although today's CPI release is good news, inflation is slowing again. High inflationary expectations on the part of businesses and consumers, combined with a weak economic outlook, definitely makes the future uncertain. Further, as the bond market showed today, it's not exactly certain that the future is ours to control. With that said, we will continue to track the Bank of Canada's efforts to control the Canadian economy to get that inflation rate back down to target on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.